Measurement fundamentals. We're going to end this series of, or this playlist, by talking about two exceptions to the measurement principles. And you'll remember that one of the exceptions is the materiality exception, which says you don't have to follow the measurement principles of objectivity, revenue recognition, matching, or full disclosure if it is so immaterial that it would have little or no effect on users' decisions. The question is what is material? So it used to be that it was based upon a certain percentage. So if you had 5% overstatement of net income, that was the threshold of materiality. And the SEC said, oh no, we will not use any percentage or numerical threshold as a basis of what is material. So instead, they gave some guidance, and the guidance came in SFAC number 2, which basically said the omission or misstatement of an item in a financial report is material if, in light of the surrounding circumstances, the magnitude of the item is such that it is probable that the judgment of a reasonable person relying upon the report would have been changed or influenced by the inclusion or correction of an item. So in other words, if a reasonable person knew about it, would they change their mind? And if they would, then you need to include that piece of information no matter how small it is. And in addition, the Supreme Court has also held that it is a material if there's a substantial likelihood that the fact would have been viewed by a reasonable investor as having significantly altered the total mix of information made available. So again, materiality is all in the eyes of the user. Is this piece of information relevant to the judgment of the user in making informed decisions? In addition, the SEC has also laid out some guidelines or valuable insights to help the investor in making these decisions about material judgments. Most of this is talking about whether the company is trying to hide or change losses into income, or is looking at masking something that is going on, or that it would affect compliance issues with regulatory agencies or with loan covenants, or has an effect of increasing management's compensation. Remember those bonuses? So those are all things that you have to think about when we look at materiality. Here's an example. All large U.S. companies have policies in which all expenditures under a certain dollar amount are expensed. These are called de minimis expenses, meaning not big enough to account for. Many of these expenditures are for assets, items that are useful to a company beyond the period in which they're purchased. Explain the proper accounting treatment for expenditures for items that are expected to generate benefits in the future. They're known as capital expenditures and should be included as assets because they have future or potential value. Now, why would they not? Part B, explain why it makes economic sense to expense some of these items. Upon which exception to the principle of financial accounting would such a decision be made? And we know that it's based upon the materiality exception, which basically says the cost of keeping the accounting records versus the benefits of keeping all those accounting records and tracking all of it, those assets as they become expenses, don't weigh out. So in other words, it costs you a lot more to track and account for it from asset to expense than the benefits you would receive from doing such tracking. And so because it is so immaterial in amount, we allow those costs to be expensed in the period in which they're incurred. So again, those are called de minimis expenses, meaning so little, why track them?